Did you know that millions of people in India put their savings into the stock market, yet most end up losing money? Why does this happen? Because they rely on outdated strategies, follow poor advice, or invest blindly in stocks simply because a friend or relative recommended them. Has this ever happened to you? If so, share your experience in the comments below. But today you're going to learn about 7 of the simplest and most effective investments that can help you build wealth, even if you're starting with almost nothing. Each one is built on the timeless principles of the Pro-Buffett HQ approach, principles designed to keep your money safe, invested wisely, and positioned to grow many times over. The best part? Anyone can start today. You don't need huge capital or an advanced degree. And make sure you stay with me until the very end, because the final investment on this list has the power to accelerate your wealth at a pace few people even know is possible. Those who grasp this strategy often end up changing their financial lives completely. So, let's dive in. 1. Index funds, a share in the market leaders. Ever wished you could invest in India's biggest companies like Reliance, TCS, or HDFC Bank without needing a fortune? With index funds, that's not only possible, but remarkably simple. Think of them as a basket containing the leading companies in the economy. Instead of buying just one stock, you're buying into the growth of the entire market. Take Nifty 50, for example. It includes India's 50 largest companies. With just a few hundred rupees, around $6, you can become a co-owner of these market giants. The strength of index funds lies in diversification. If one company underperforms, others help balance the risk. History proves it. Over time, Nifty 50 has delivered average annual returns of 12 to 14%. And you don't need to be an expert. If you can open a bank account, you can open a demat account with brokers like Zerodha or GrowW and begin investing with as little as 500 rupees. Index funds are like planting a tree. At first you nurture it, and later it keeps rewarding you with returns for decades. 2. REITs, real estate. Without owning property, have you ever imagined earning from real estate without buying a house or dealing with tenants? That's exactly what REITs, real estate investment trusts, make possible. They pool investor money and buy large assets like shopping malls, office buildings, hospitals, and warehouses. You don't manage the property, but you still earn a share of the profits, often paid as monthly dividends. It's like owning part of a massive real estate empire without the headaches of ownership. In India, examples include Embassy Office Parks, REIT, and Mindspace Business Parks, REIT. You can purchase them directly through your brokerage account. For safety, choose REITs that hold high-quality commercial spaces. If you want to try something different, consider REITs focused on tech properties such as data centers. 3. Dividend aristocrats, the reliable payers. Some companies not only pay dividends every single year, but actually increase those payouts consistently. These are called dividend aristocrats. They are the true royalty of the market, resilient businesses that withstand crises and still reward shareholders. Think of Hindustan Unilever, ITC, and TCS. Even in downturns, they've maintained their dividend record. It's like having a steady income stream that never dries up, or a dependable friend who supports you in every challenge. You can buy their shares directly or invest in ETFs that focus only on strong dividend-paying companies. For anyone seeking stability and steady income, these stocks are essential. 4. Bonds, the safe haven. Let's turn to one of the safest places for your money: government and corporate bonds. Think of it as a safe place where your money is protected, even if the stock market is in free fall. That's the role bonds play. Government bonds, GSECs, are considered among the safest investments in the world, backed by the government itself. Through the RBI's Retail Direct scheme, you can invest directly and earn around 6 to 8% annually. Corporate bonds from reliable institutions like HDFC or L&T often pay even higher interest. Think of it as lending money to a trusted organization, and they thank you with steady interest payments, When markets crash, bonds continue providing regular income. That's why they're a cornerstone of a balanced portfolio. 5. Technology funds, betting on innovation. If safety is important, growth is just as vital. That's where technology funds come in. Imagine investing in companies that shape the future, those driving smartphones, software, and India's digital revolution. During the COVID crisis, while many sectors suffered, tech companies not only survived, but thrived. Why? Because technology is becoming essential in every aspect of our lives. Funds like ICICI Prudential Technology Fund or tech-focused ETFs make it easy to participate in this wave of innovation. 6. Small cap ETFs, tomorrow's market leaders. Remember, today's giants were once small players. Infosys and Titan started small before growing into global powerhouses. Small cap ETFs, such as those tracking the Nifty, Small Cap 250 Index, give you a chance to invest in businesses still in their early growth stages. Yes, they carry higher risk, but the potential rewards are extraordinary. Historically, small cap stocks have outperformed large caps over long periods. They're like seeds that can grow into towering trees. The real question is, do you believe that small companies can create big opportunities? 7. Commodities, protecting against inflation. What happens when inflation silently erodes your money's value? That's where commodities like gold, silver, and oil act as a shield for your wealth. In India, gold is more than just an investment. It represents tradition and security. During financial crises, when most assets fall, gold prices usually rise, and you no longer need to buy physical gold. Instead, you can invest in sovereign gold bonds, SGBS, issued by the government. These not only track gold's price, but also pay an additional 2.5% annual interest, along with tax benefits. That's truly gold on top of gold. Other commodities like oil and gas remain vital for the global economy, ensuring steady demand. Together, they strengthen your portfolio in uncertain times. Final thought. As Warren Buffett wisely said, risk comes from not knowing what you're doing. Now that you've learned the smartest ways to grow and protect your money, it's time to put this knowledge into action. Always remember, financial freedom begins with a single decision: the decision to invest in your future.